What we witnessed from January 2025 through February 2026 is not just a price rally. It is one of the most extraordinary, record-shattering, history-making runs any commodity has ever produced in modern financial markets. Silver went from $28.92 at the open of 2025 to a jaw-dropping all-time nominal high of $121.67 on January 29, 2026. That is a gain of over 320% in approximately 13 months. It blew past every analyst forecast, shattered a 45-year-old record, and sent shockwaves through commodity markets around the world. Today, we are going to walk through this entire journey, every major turning point, every catalyst, every moment where the market was tested, and then we are going to look ahead and ask the most important question of all: where does silver go from here? Grab your coffee, let's get into it. Before we talk about what happened, we need to understand why it was even possible, because a move of this magnitude doesn't come from nowhere. It is built on a foundation of years of structural imbalances, and in silver's case, that foundation had been cracking for a very long time. The story actually begins back around 2020, in the depths of the COVID-19 pandemic. Silver was trading at just $12 per ounce in March of 2020, almost giveaway pricing for a metal this critical to modern industry. As stimulus money flooded the economy and inflation began to take hold, investors started piling into precious metals as a hedge. Silver surged to nearly $30 by August of 2020, more than doubling in 5 months. But then it stalled. For the next 4 years, silver traded in a frustrating sideways range. It went up, it came down, it failed at $30 multiple times. Wall Street moved on. Retail investors got bored. The narrative on silver faded into the background. But beneath the surface, something critical was building. The global silver market was running a structural supply deficit, meaning the world was consuming more silver than miners were pulling out of the ground. And this wasn't a one-year fluke. By 2025, the silver market was entering its 5th consecutive year of supply deficit. Global demand had hit an estimated 1.2 billion ounces annually, while global supply was struggling to produce even 1 billion ounces. That gap, roughly 160 to 200 million ounces per year, was being filled by drawing down above-ground stockpiles. And those stockpiles were getting dangerously thin. Why was demand so high? 2 words: industrial revolution. But not the kind from the 1800s. This was the green energy and artificial intelligence revolution, and silver sits right at the heart of both. Solar panels require silver. A lot of it. Each photovoltaic panel uses approximately 20 grams of silver for its electrical conductive paste. As the world accelerated its push toward renewable energy, solar installations were growing exponentially. In 2024, solar manufacturers consumed over 25% of the entire global annual silver supply, and that figure was rising again in 2025. Electric vehicles use silver in their battery management systems, sensors, and charging components. Every new EV on the road is another silver consumer that never existed before, and then came artificial intelligence. This was the wildcard that most analysts hadn't fully priced in. AI-driven data centers consume 2 to 3 times more silver per unit than traditional servers. As companies around the world rushed to build the infrastructure for the AI economy, the chips, the servers, the cooling systems, the circuit boards, silver demand from the technology sector exploded. The United States was 100% import reliant for several critical minerals used in AI data center infrastructure, and silver was at the center of it all. On the supply side, things were equally constrained. Global silver mine output had actually fallen from about 1.07 billion ounces in 2010 to roughly 1.03 billion ounces in 2024, even as demand surged. Mexico, the world's largest silver producer, saw regulatory changes in 2024 and 2025 that cut expected output by around 5% in affected regions. Meanwhile, silver is primarily mined as a byproduct of zinc, lead, and copper mining, meaning its supply can't simply be turned on like a tap when prices rise. It takes years to develop new mines, and the investment just wasn't there. So when we talk about silver's journey from $30 to $121, we have to understand that the rocket was already fueled. It just needed a match. January 2025 opened with silver at $28.92. Modest, quiet, almost unassuming. But within the first 5 days of trading, silver broke through the $30 barrier. Analysts noted it, but few were alarmed. $30 had been a ceiling before. Maybe it would be again, but this time was different. By January 29th, silver had pushed to $31.31. By February 20th, it was at $32.94. And by March 28th, it posted a quarterly high of $34.21. Then came the first major test. On April 2nd, the Trump administration dropped major tariff announcements that shook global markets. Fears emerged that if tariffs hit industrial goods, demand for silver in manufacturing could soften. Silver pulled back below $30 briefly. The bears thought they had won. They were wrong. The fundamental story was too strong. Tariff anxiety faded, and a new, more powerful narrative took hold. The Federal Reserve was getting ready to cut interest rates. Lower rates mean a weaker dollar and lower bond yields, both of which push investors into real assets like silver. Anticipation was building, and silver began climbing again steadily through the summer. By June 2025, silver hit what was then called a 13-year high, breaking $37 per ounce for the first time in over a decade. Old records were falling. Market participants started paying serious attention. September 22, 2025 brought another milestone, $44.31. The mood in the silver community was shifting from cautious optimism to genuine excitement. Geopolitical tensions were escalating. U.S.-China trade friction was intensifying, with China threatening export controls on rare earth metals, and the U.S. responding with threats of 100% tariffs on Chinese imports. Investors globally were rotating into safe haven assets, and silver was on their radar. Then came October. On October 9th, a date silver investors will not forget, silver crossed $50 per ounce. It had taken 45 years and 2 near misses to crack this level. The previous nominal all-time high of $49.95, set on January 17, 1980, during the Hunt brothers' infamous corner attempt, had stood untouched for 4.5 decades. Now it was gone. Retail investors swarmed back into the market. The mood was electric. Articles and headlines exploded. Social media lit up. Everyone wanted to know how high it could go. The acceleration was unlike anything the silver market had seen in living memory. On October 22nd, silver was above $51. Just 12 days later, on December 9th, it crossed $60. Another 13 days, and it was at $70. A single 24-hour period, from December 25th to December 26th, saw silver surge over $7 in one session, from around $72 to above $79. These were moves that, in prior years, would have taken months to accomplish. By December 10th, the Federal Reserve cut interest rates again, providing fresh fuel. Silver finished 2025 well above $70, posting a gain of approximately 147% for the full year. Every analyst had been wrong, not because they were incompetent, but because the velocity of the move was simply unprecedented. What was driving this extraordinary acceleration? Several forces were colliding at once. American companies were panic buying physical silver and stockpiling it in U.S. vaults to avoid potential tariff risks on imports. COMEX, the primary U.S. silver futures exchange, saw warehouses fill with over 500 million ounces as companies moved metal domestically. This created a corresponding shortage in London, the other major global silver trading hub, where available physical silver ran dangerously low. Lease rates, the cost of borrowing silver, jumped more than 30 times their normal levels during periods of acute stress. The market was in backwardation, meaning physical silver commanded higher prices than futures contracts. That is a red alert signal in any commodity market. China simultaneously tightened its controls on silver exports, further constricting global supply just as demand from its own massive solar manufacturing sector was rising. The system had become a pressure cooker, and the temperature was still rising. If 2025 was the year silver woke up, January 2026 was when it became front-page news for every financial outlet on Earth. As the new year opened, silver was already north of $80. Institutional momentum was building. Hedge funds were piling in. Retail investors who had missed the 2025 run were now rushing to buy. The narrative of structural deficit, AI demand, solar demand, tariff risk, and Fed easing had fully converged. Silver was unstoppable. On January 15, 2026, silver crossed $95 per ounce, setting a new all-time nominal high. The De Beer Group's CEO Nigel Green went on record saying the rally had significant room to run and projected that silver could reach $200 per troy ounce by the end of 2026. BNP Paribas's senior strategist Philippe Geisels told CNBC that silver could potentially double from there. The gold-to-silver ratio, which had previously required around 105 ounces of silver to buy 1 ounce of gold, had compressed to approximately 50. And then, on January 29, 2026, silver reached its all-time nominal peak, $121.67 per troy ounce. Let that sink in. A metal that most people had ignored for years. A metal that couldn't break $30 for the better part of a decade. A metal that was trading at $28 just 13 months before. It was now at $121. On the very same day, January 29th, gold also hit a record of $5,594 per ounce. It was a moment of synchronized mania in precious metals markets, and then the rug was pulled. On January 30th, silver crashed over 26% in a single day, from over $120 back toward $90 in hours. Early February saw another brutal leg down of approximately 20%. In less than 2 weeks, silver had given back 35 to 38% of its peak value. The metal that had just made history was now making headlines for a different reason. What happened? U.S. Treasury Secretary Scott Bessent stepped to the podium and publicly attributed the extreme volatility to Chinese speculators, calling the rally a classical speculative blow-off. Chinese retail and institutional investors had been pouring into precious metals through platforms like the Shanghai Futures Exchange, where trading volumes had averaged 540 tons per day year-to-date, up from 457 tons in all of 2025. The speculative froth had grown to dangerous levels. COMEX responded by raising margin requirements twice within a single week. The cost of holding leveraged silver futures positions shot up dramatically overnight. Weaker capitalized traders were forced to liquidate immediately. Leverage that had amplified gains on the way up was now magnifying losses on the way down. The cascade of forced selling was vicious and fast. This wasn't the first time this had happened in silver's history. In 1980, when the Hunt brothers cornered the market, COMEX instituted Silver Rule 7, heavy restrictions on buying with debt, which caused a similar crash. In 2011, the exchange raised margins 5 times in 9 days, collapsing silver from $48 to $32 in less than a month. History rhymed perfectly. As of today, Tuesday, February 17, 2026, silver is trading at approximately $74 to $75 per ounce on the U.S. market. This is the first domestic trading session of the week following yesterday's President's Day holiday closure. That means silver is currently sitting about 38% below its all-time high of $121.67 set just 19 days ago. On the surface, that looks catastrophic. But let's put it in perspective. Silver started 2025 at $28.92. Even at $75 today, it is still up approximately 159% over the past 13 months. The year-over-year gain is still extraordinary by any measure. The gold-to-silver ratio currently stands at approximately 63.4 to 1, with gold trading near $5,000 per ounce. That ratio is actually historically elevated for a period like this. In previous major bull markets, it has compressed well below 40. Some analysts argue this means silver is still significantly undervalued relative to gold. Technically, the chart is showing a market in post-mania consolidation. Resistance is clustered between $79 and $82, and silver needs to reclaim and hold above $79.42 to signal that the correction is over and buyers are back in control. Below current levels, there is meaningful support around $75.60. If that breaks, the next zone to watch is the $70 level. A falling wedge pattern is forming on shorter-term charts, a classic structure that technical analysts associate with potential bullish reversals. It doesn't guarantee a bounce, but it tells you that the sellers are losing momentum and buyers may step back in. Fundamentally, the case for silver hasn't changed one bit. The structural supply deficit is still there. The Silver Institute projects a deficit of 67 million ounces for 2026, even as supply may hit a 10-year high of 1.05 billion ounces. The AI data center build-out continues. Solar installations are not slowing down. The Fed is expected to keep rates steady in March, but has 2 rate cuts priced in for later in 2026. Russia, in a historic first, is still executing its multi-year plan to accumulate $535 million in silver reserves, the first major central bank in the modern era to openly add silver to its balance sheet. Now we get to the most important part of this video. Where does silver go from here? Let's be honest about something first. Nobody, not JP Morgan, not Bank of America, not the most senior traders at COMEX, can tell you with certainty what silver does next month, next quarter, or next year. The metal just proved that it can do things no one expected. So what we can do is lay out the most realistic scenarios, the forces that will shape each one, and what you should be watching. The bull case for silver is still very much alive. JP Morgan Global Research has set a 2026 average price target of $81 per ounce, more than double where silver averaged in 2025. Bank of America's head of metals research Michael Widmer has an extraordinary $309 silver price target for 2026, based on historical gold-to-silver ratio compression. The De Beer Group projects $200 by end of 2026. Gold Silver's lead analyst Alan Hibbard expects silver to trade above $100 again in 2026 as supply deficits deepen. One analyst from silver stock investor Peter Krauth views $50 as the new floor and targets the $70 range as a conservative baseline. Some of the more aggressive forecasters, like those at Gold Silver, are not ruling out a move to $175 or higher before 2026 is out. The bullish thesis rests on several pillars. The supply-demand imbalance is structural, not cyclical. You cannot fix a mining shortage overnight. The industrial demand from solar, AI, EVs, and electronics is not going away. These are multi-decade infrastructure build-outs. The macro backdrop of Fed rate cuts, persistent inflation concerns, US dollar weakness, and geopolitical uncertainty all support precious metals, and critically, physical silver premiums remain elevated even after the crash. Solar and EV manufacturers who stepped back when silver hit $120 have reportedly returned as aggressive buyers in the $80 range, suggesting industrial buyers are using this correction as a restocking opportunity, which creates a natural price floor. The bear case centers on whether the speculative fever that drove silver to $121 was fundamentally justified, or whether it was, as Scott Bessent said, a speculative blow-off that overshot fair value significantly. If speculative flows reverse further, especially if Chinese retail investors retreat and institutional leverage positions continue unwinding, silver could face additional downward pressure toward the $60 to $70 zone in the near term. A stronger than expected US dollar, a delay in Fed rate cuts driven by sticky inflation, or a sudden weakening of global industrial activity could all act as headwinds. There's also the risk that COMEX inventory buildup, which now holds over 500 million ounces, creates an overhang that the market needs to absorb before prices recover meaningfully. The most likely near-term path is volatile consolidation. Silver is doing now what it did in 2011 and in 1980 after its speculative peaks. It is shaking out the weak hands, clearing the excess leverage, and finding a new equilibrium level that is still far above where it started. In 2011, silver crashed from $48 to $26, a 45% correction, and then stabilized in the $15 to $20 range for years. In 1980, it went from $50 back to $10. But here's the critical difference. This time, the fundamental underpinning of that structural industrial demand deficit didn't exist in 1980 or 2011. Back then, precious metals were almost purely monetary and investment assets. Today, silver is consumed in quantities the world cannot replace, by industries the world cannot shut down. That distinction may be the most important thing to take away from this entire video. The structural floor for silver in 2026 is almost certainly higher than it was after previous peaks, because even if every speculative investor exits the market tomorrow, solar panels still need silver, AI servers still need silver, electric vehicles still need silver, and there are not enough ounces in the ground to satisfy all of that demand. Looking 12 to 18 months out, the question is not really if silver recovers, it is how fast and how far. If the Fed delivers its expected rate cuts later in 2026, the dollar weakens further, and industrial demand remains firm, the path back toward $80 to $90 and potentially retesting $100 is credible. If geopolitical tensions spike further, and the landscape of US-China relations, Middle East instability, and Europe's security situation gives plenty of reasons to worry, safe haven buying could accelerate that recovery dramatically. Conversely, if global economic growth softens meaningfully and industrial demand disappoints, the recovery may be slower and more grinding, with silver finding a new range in the $60 to $75 zone before mounting another attempt higher. One wild card that almost nobody is talking about loudly enough is the U.S. tariff policy. Section 232 tariff considerations have already caused companies to pull hundreds of millions of ounces of silver into U.S. vaults. If the administration moves to formally impose tariffs on silver imports, it would create an immediate and severe supply squeeze in markets outside the United States, potentially triggering another explosive upside move. Watch that policy space carefully. Beyond the price action, silver's 2025 to 2026 journey teaches us several important lessons that apply to any investor watching any market. The first lesson is that structural stories are slow until they are not. Silver's supply deficit had been building for 6 straight years before prices exploded. The AI and solar demand trends were known for years before they showed up dramatically in silver prices. The market is often late to price in structural change, and when it finally does, the repricing can be violent and fast. The second lesson is that leverage is a double-edged sword. The same margin and futures positions that allowed traders to ride silver from $30 to $121 also forced mass liquidations on the way down. The parabolic rise was amplified by leverage. The crash was amplified by leverage. If you are trading silver with margin, the message from January and February 2026 could not be clearer. The third lesson is to distinguish between the paper market and the physical market. Even as COMEX silver futures sold off brutally, physical silver premiums remained elevated. Industrial buyers continued purchasing at the spot market. The physical story never changed. Traders who panicked and sold physical silver into the crash based on paper market noise may come to regret it when prices recover. The fourth lesson is that history rhymes. The 1980 Hunt Brothers peak, The 2011 QE era peak and the 2026 peak all followed remarkably similar patterns. Speculative fever drives a parabolic move, exchanges intervene to raise margin requirements, leveraged positions collapse, prices crash hard and fast. But in each case, the new floor was dramatically higher than the old floor. Silver went from $50 in 1980 to a floor of roughly $10 to $15, but that was still 10 times higher than where it was in 1971. After 2011's $48 peak, it settled in the $15 to $20 range, still 3 to 4 times higher than its pre-rally levels. After this peak at $121, even a 50% correction puts the floor at $60, still more than double where 2025 began. Silver's journey from $30 to $121 is not just a story about a commodity. It is a story about the intersection of global technology, geopolitics, monetary policy, and the extraordinary power of structural supply-demand imbalances. It is a story that caught most of the financial world off guard and rewrote the history books in real time. As of today, February 17, 2026, silver sits at around $74 to $75, battered from its peak, yes, but still up more than 150% from where this journey began. The fundamental reasons that drove this rally have not disappeared. The deficits are still there. The industrial demand is still there. The macro tailwinds are still there. Whether silver goes back to $121 or pushes toward $200 or spends the next year grinding through a correction, nobody can tell you that with certainty. But what the data tells us is that silver has permanently repriced. The era of $20 and $30 silver appears to be over. Thoughtful. The question now is what the new normal looks like. If you found this breakdown valuable, hit that like button, subscribe for weekly silver and precious metals market updates, and drop a comment below with your silver price target for the rest of 2026. I read every single one, and remember, this video is for educational purposes only and does not constitute financial advice. Always do your own research and speak with a qualified financial advisor before making any investment decisions. Chuckles. I'll see you in the next one.